Today, we are executing a 7-pillar review of UnitedHealth Group, ticker UNH, to establish a capital allocation strategy. The stock is exhibiting hyper-growth technical behavior, yet the underlying operating margins are significantly compressed. Over the last 5 weeks, the price surged 40%. Looking at the market analysis, we see a technical regime shift. Price reclaimed the 50-day and 200-day moving averages, confirming a breakout. That breakout caused an overextension. Momentum data shows the RSI at 82.86, an overbought reading. The mean reversion risk is measurable. The current price is 10.9% above the Bollinger middle line. While the medium-term trend is upward, the immediate entry point carries elevated technical risk. Sentiment has shifted rapidly from systemic panic over medical cost trends to market complacency. Institutional accumulation volume is peaking at the same time the RSI crossed above 80, creating a crowded rebound trade. Crowded positioning at these technical heights creates a floor that is susceptible to rapid liquidation. Relying on pure momentum when sentiment is this stretched violates core risk management principles. Macro tape developments forced short covering recently, specifically the Q1 earnings beat and raised guidance. Goldman Sachs also added UNH to its conviction list with a $435 price target, providing institutional support for the rally. However, these catalysts are being balanced against ongoing Department of Justice investigations and regulatory overhangs that the market is currently overlooking. This setup creates a vulnerability where regulatory developments make hap near-term multiple expansion, regardless of quarterly performance. Over the trailing 12 months, UNH generated $449.7 billion in revenue, but in Q4, net income dropped to $10 million, yielding a single penny in diluted earnings per share. Patient demand remains steady, but margin compression has pushed quarterly free cash flow down to $160 million. The balance sheet shows tight liquidity, with a 0.80 current ratio, negative tangible book value, and a debt-to-equity ratio of 73.98. A leveraged balance sheet requires consistent operating cash flow to service obligations. With that flow under pressure, the margin for error has narrowed. The bull thesis relies on a 17.8 times forward PE, assuming rapid earnings recovery and a bottoming of the Medicare Advantage underwriting cycle. However, a forward multiple is an assumption of normalization rather than evidence of fundamental value. The market is treating a technical rebound as if it were a permanent structural change. If Medicare Advantage pressures remain unresolved, the asset could face multiple compression. Given these levels, do not deploy fresh capital at the current price. Re-entry zones for new capital start at the 10-day exponential moving average, near 355. A deeper retracement target required to work off overbought conditions is the Bollinger midline, near 333. For existing holders, risk can be managed by trailing stops using the average true range of 9.35 to account for volatility. The current position sizing rule is to maintain UNH at a benchmark or neutral weight. Avoid initiating overweight positions following a 30% move that is not yet supported by fundamental data. Verifiable evidence of medical cost stabilization and free cash flow recovery in subsequent earnings will be required to alter this allocation. Portfolio managers should wait for data to confirm the narrative, rather than paying a premium for expectations. UNH's massive revenue scale and long-term franchise qualities support staying invested rather than turning defensive. However, that scale is currently being offset by the technical extension, unresolved margin compression, and heavy balance sheet leverage. Standard protocol prevents paying premium multiples for a fundamental recovery that has not yet been demonstrated. The final capital allocation directive is hold. Maintain exposure, avoid chasing the current levels, and wait for technical digestion.